risk management. And for me, this is the absolute number one most important aspect of your trading career. Because if you do not manage your risk, eventually you will blow your accounts out. You may have a successful run for a period of time, but eventually it will happen. The other important thing about risk management, especially in the beginning of your career while you're learning, is this is what's going to keep you in the game through the bumps and bruises you're going to take while you're learning, through those mistakes that you're going to make while you are learning and getting that experience. And then once you gain that experience, you're going to understand that risk management is probably the single most important part of your trading strategy. So first and foremost, always use a stop loss. Whenever you place a trade, always have a stop loss in place. And don't move your stops, folks. Don't move your stops. Place your stop loss and leave it alone. The only time you want to move your stop is to reduce risk or remove risk. Okay, you never want to move your stop further away. Ever. Okay, do not over leverage your trades. We talked about the dangers of over leveraging earlier. Okay, this is all part of risk management. If you're over leveraging your trades, you're not properly managing your risk. Because there's things that you cannot account for, such as slippage. Some of these extreme market moves can cause a deal of slippage. Now, if you have very high leverage on your trades, that means that each pip has a much higher value. And any amount of negative slippage is that much more damaging to your overall account capital. These are the basic rules I'd like to have in place. Do not risk more than 1% on short-term trades, 2% on medium or longer-term trades, and 3% on a combination of all open positions in the market. Now, this might seem a bit conservative, and to be absolutely honest with you, I usually don't risk even 1% on my short-term trades. But again, I'm approaching this from a fund manager point of view, where I am targeting high net worth clients, and they are much more concerned with the risk and the drawdown than they are about really high returns. Okay, they're very happy with modest annual returns. And stay consistent with your risk. Okay, don't try to make up losses. That's a very dangerous mindset. First of all, you want to remember when once a trade is over, it's over. It's done. Next trade. You're moving on to the next trade, and that means you're not thinking about your previous trade, whether it's a winner or a loser. You don't want to think about that trade because it's going to affect your emotions. It's going to affect your actions for your next trade. Okay, so we take a loss. We go down 1%. Don't double up on your next trade. Don't think in your mind that you have to make up that loss, because you don't. You don't. It's an individual trade. It's a small part of the bigger picture. Okay, continue to stay consistent with your risk, with your trades, and the numbers will work out. Folks, if you take one thing away from this course and nothing else, take away risk management. Okay, I always tell folks, look, if you're going to take away any teaching from me, if you're only going to take away one thing, you don't have to agree with anything else I say. Take away risk management. You don't have to do it exactly like this, but you need to have a strict risk management plan in place. It is absolutely critical to your Forex trading success.